Hi, everyone. Welcome to the Timing Research Show for March 28th, 2016. My name is David Kosmeter. I'm the creator of Timing Research, and today we will be talking about the 131st weekly report. If you haven't had a chance to take a look at this yet, just go to TimingResearch.com/reports, and you can download this or any past report there. I have Dave Landry back to host this week, so I'm going to go ahead and turn it over to him.
David Cosmenter, and thanks to Timing Research for having me back once again. We've got a full room today. Everybody here is a veteran, so glad to have all of you guys back. I think for the most part, you probably know the routine. Dean, let's go to you first. Tell us a little bit about yourself, and tell us a little bit about followmetrades.com.
All right, thanks. And it's good to be back here. I think this is my
Glad to have
sixth
you.
time on the show. I always enjoy this. This is a great forum. So I'm Dean Jenkins, founder of followmetrades.com, and we have a stock picking service. So people subscribe and we call out our stock picks, and they've been doing real well for several years. We got a good year going here. We include option picks with the stocks as well. And I'm a technical trader, strictly technical. I believe that a corporate earnings statement is some of the finest fiction written in our current time.
Amen.
um, I use Dow theory. I use Elliott wave, a very simple form of Elliott wave, and I don't get all into the geeky Elliott wave stuff. Just look for big trends, corrections in the next trend. And I also use the applied reality trading tools and just try to trade the reality of the charts. You know, it's all right there in front of us. There's a story playing out. So that's what we do.
Amen. Can't argue with that. All right, James Romelli of AlphaShark Trading, you're up next. Tell us a little bit about your trading and tell us a little bit about AlphaShark.com.
Great, sure. So we have a huge variety of products and services that we offer, mostly geared towards retail equity options traders. And while we trade a whole wide variety of strategies and trading plans, our main bread and butter and our main goal is to use unusual options activity, meaning big blocks of equity options being bought or sold by big institutional traders, as a guide to where money flow is going in the market, and as a way to kind of get in ahead of potentially large moves, as that is generally how these institutional equity options traders go about doing the same thing. So we spend all day looking at the tape, looking at big block trades that are coming across, filtering out the ones that represent non-actionable ideas or just noise or hedging activity, and try to focus in on the biggest and most suspicious and interesting looking equity options bets being made by institutional traders. So that's basically
they're going to leave a They're going to leave a footprint. You're looking for that. I was going to ask you how do you filter out just the hedging, but that's fascinating. I'm sorry, I didn't mean to cut you off. I thought you were done. Go ahead, keep going.
No, that's pretty much it, and that's a great question, and that's kind of the art of trading unusual option activity is every single trade that comes across the tape, no matter what it looks like, always has the possibility of being a hedge or a speculative bet. Those are the two main participants in the equity options market. So we look at a lot of things like technical setups. Generally speaking, if it is a hedge, it's something that, you know, completely disagrees with the technical setup. If we see big blocks of puts being bought as the stock makes new 52-week highs, you know, that reads itself as a hedge. But there's probably a dozen different ways that you can look at an order and different things that we look at. And I don't know that we'll get into that too much in this discussion, but I'll tell you guys how you can find out more about it at the end.
All right. A little tease there. All right, Jason Jakowski, it's to you next. Same thing. Tell us a little bit about yourself. For those of us who don't know you, you've been here quite a few times. And tell us a little bit about theliononline.com.
Well, thanks for having me again, Dave. And Dave, it's always my pleasure to do this one with great guests today, too, that looks like we're going to have a great conversation. I'm always excited to do that. And because I really focus on the psychology behind trading, and I personally feel that that is more significant than most people tend to give credit to. The actual underlying psychology inside the market. I think you need to look for clues. Whether you use technicals or fundamentals to do that, you need to look for clues to understand the basic quality of what's happening in the market from the standpoint of the participant, what they're thinking and feeling and participating in. And that's what I do all day long in my proprietary method of trade analysis and all the rest. And you can find out more about that at my website, The Lion Online, all one word, theliononline.com. And I'm sure we'll have plenty of time to talk about it as time goes on. But for right now, I just want to focus on helping the listeners, the new guys, understand that what I tend to do focuses heavily on the underlying psychology of what's occurring.
Yeah, it's kind of interesting. I fully agree with you. As you know, every time you're on, we have this big agreement fest. But yeah, as far as it comes to psychology, that's one of the complaints about the show is we get along too well. But the thing about psychology, it's funny, when you first started this business, you're a setup junkie and you're searching for the Holy Grail, and then you realize you might need a little money management, and then 10 or 15 years later, you figure out, well, wait a minute, I've got to get this psychology thing down, and maybe I should worry about that.
Yeah, that's a very common evolutionary process, I think, for most traders.
Yeah. All right, Sam Borgi of TradingGods.net. Same question to you. Tell us a little bit about yourself, and tell us a little bit about TradingGods.net.
Great. Well, hello, everyone. It's a pleasure to be here, as always. I believe it's my fifth time on the Timing Research Show. It's always a pleasure. I'm currently a markets editor for TradingGods.net, which is essentially an online trading platform as well as educational resource for helping investors really unravel the volatility market, looking at how VIX ETNs, and various VIX products impact the overall market. So a lot of the work that I've been doing recently has been around helping investors assess the role of volatility in driving the S&P 500 in various different markets. And you can find out more about us at TradingGods.net. We currently offer a VIX Trader, which is essentially a complete tool for understanding VIX ETNs and how to apply volatility to your daily trades. And really, I definitely agree with everything that's been said about trading psychology. And I think that looking at volatility, you can kind of see trends in psychology and how traders are reacting to certain movements in the market. So glad to be here, guys. Thanks.
Yeah, amen. And I think at least my form of technical analysis, I believe that you use the charts to read the emotions of the others, and when you go to act upon that, you just have to keep your own in check. My name's Dave Landry, for those of you who have been in the show before or some of the shows that I host, DaveLandry.com, easy for me to say. I believe you can only predict the short term when it comes to markets. I am a 100% technical trader. I have a 21-page report on that. If you go to my website under Getting Started, you could download that right away. I think it was Dean, I also have a stock picking service out there, and I'll mention that towards the end of the webinar today. And so far, we've had a pretty good year in 2016, knock on wood, in spite of a kind of a crazy market. I also think that my main goal with DaveLandry.com is to educate in a simplified way, and to boil it all down and avoid. In fact, I only use a few moving averages on occasion as an indicator, and I just like to use blank charts and try to simplify it. I think, like all traders, we all go through this holy grail hunt until we find something that's a lot simpler than what we originally start with. So I totally believe in that. I actually acquired the domain and the a copyright, Trading Simplified. Anyway, let's go back to you, Dean. Based on any technical fundamental indicators you want to use, and then we'll get to flesh this out in a few minutes too, but maybe give us a few thoughts now. But based on any technical or fundamental indicators you want to use, would you predict that the S&P 500 index will move higher or lower this week? And that's obviously from today's open to Friday's close. And then once you give us your opinion on that, rate your confidence to that answer by estimating the probability that you have correctly predicted this week's market's move.
Okay. So I guess when we get into it deeper, I'll show a chart, but for now, I'll just give my...
Yeah, that'd be great. Yeah, get that ready to go.
Okay. Yeah, whenever I talk about the market, I want to have a chart in front of me.
Gotcha.
So I predict that the market will go down from this point.
Okay.
And it's funny, I saw the sentiment indicator, the report that David's publishing, and it's just slightly calling for down as well. And I just read a really interesting study that said if you go pulse the general public, then they ask what's the market going to do. It's always what the market just did, right? If the market's going up, they're going to predict it will go up. If it's going down, they predict it would go down. So subscribers are a little bit smarter, I think. So I'll make a technical case for why I think it's going down, but I do think it's going down this week, and I give that about a 75% confidence.
Okay. Yeah, one of my problems with some of these big sentiment indicators is that the market, it's just what you said. It makes a lot of sense. I'm glad you mentioned that. I might quote you on that because the numbers are always going to be their highest when the market is at its highest. And so people could always say, look, the bullish sentiment was always the highest, and then the market, but it could stay there for a long, long time as long as the market continues to make new highs. That's a great way of putting it.
The other thing, the fear and greed index. So I don't trade based on that, but it's an interesting idea. CNN's fear and greed, and it's pegged. It's pegged as of the last 3 weeks at max greed, right? Like up in
really?
the like 80s, which is and there's research that shows as soon as it pegs and at max greed, it corrects pretty quickly after that, a high percentage of the time. But I don't trade based on that, right? But it's interesting. It's interesting.
Well, I think everybody just wants the market to go up, or the most amount of people, and even when things look pretty ugly, as soon as it starts going back up, all of a sudden everybody gets happy again. That's just kind of a perverse thing. James, let's go over to you. James Rebelli of AlphaShark.com. Based on any technical fundamental indicators you want to use, would you predict that S&P 500 is going to be higher by Friday's close or lower? And rate your confidence to that answer on the percent that you have, the probability that you have correctly predicted this move.
Right. So I would have to say that I think my expectations for this week are going to be pretty bearish. I, however, don't think we're going to move very much to the downside. And a couple of reasons for that. One, the reason that I'd be looking to add to short positions this week or looking to establish short positions is because we've really been struggling at this technical level in S&P futures below 2040. Haven't managed a conviction break above that. No real momentum looking like we're going to break above that. But with that being said, I don't know that there's that much of an opportunity to just get short the market this week because we're really not implying very much action. Think about where we are right now, kind of near the end of the earnings cycle, lacking for broader market catalysts in general, and coming out of a holiday week. I haven't seen the order flow in equity options from institutional traders this slow in a very long time. If we take a look at the options on the futures, we're only implying we actually have 2 expirations this week, which makes it kind of easier to determine what movement is going to be like, or at least what expected movement is. We have the quarterly options expiring on Thursday, and then the serial regular weekly options expire on Friday. But from today through Thursday, all of what's left of today's trading day through Thursday, they're only implying about 17 points, which is pretty small. That's less than 5 points movement per day. So I would be looking to get short. I think that with no other catalysts, sellers are going to step into this market, take some profits after we've had this huge run higher. But it's not necessarily something that I'd be running out to short with both hands because I really don't think there's that much movement in store through the rest of the week. Even if we take a look out through Friday, which does include a catalyst, they're only implying about 22 points or so worth of movement all this week, up or down.
And why do you think it's so quiet? Is it because of the Easter holiday we just came off of, or is that what do you
think it's
there?
I think it's kind of confluence from a couple of different things. The holiday last week was just dead quiet. We didn't really see any large bets coming in equity options, long or short. And we're kind of at a time right now where we're in between earnings cycles. We don't have the day in, day out catalyst of 100 stocks reporting earnings. And when we lack for those types of micro catalysts and also lack for big macro catalysts, then this is what we tend to see happen. Order flow slows down. Add in the holiday there. I mean, the Wall Streeters are probably not all back to their desks yet today.
Gotcha.
And that's what we tend to see happen. Yeah.
Okay. Before I forget, what's the percent correct on that?
I would say about a 60% chance. Whenever they're implying such a small move, I feel more likely that it can go either way because it shows a lack of conviction from pretty much every participant in the market. It also shows that nobody is really coming in, putting on any large plays and to jack up volatility.
Gotcha. Jason, what's your 2 cents on this? Up or down, and percent correct?
Well, I would say I'm going to take all your money this week.
All right.
I think you guys on the sell side, on the bear side, I really think you're right, but you're early. I think that we've got a new.
Hey, did you see the Big Short? Michael, that's the same thing.
No, I think they're absolutely right. I do. I think all of the
Yeah.
Bears are absolutely right, but I think they're about 100 points early. I think that we're gonna get a new high for the year. I don't know if we'll get that this week, but I really like the 2075 level for selling, and that would put us real close to a fresh high for the year before the big money comes in.
That's in the back of my mind. I'm wondering if something like that did happen or could happen. I think everyone would all of a sudden feel like, oh, switch is flipped and everything's going to be fine, and that would be the mother of all fake outs. I hear you.
I really think the Bears, like a couple of the guests already have been bearish. I think those guys, you're absolutely right, but I think you're about a week early. I think that I think right about Friday, there's going to be that last push higher. I hate to say this because everybody wants more concrete evidence, but this is one of those plays where like over the weekend, I'm like, something is not right. I'm like, I'm losing sleep, and I'm like, I wake up this morning and I'm like, oh man, there's going to be one more push higher. That's going to be the head fake, because I just think that I think the Bears are absolutely right, but I think they're just about a week and a half early, and I think there's could be a solid move to the 2075 80 area, somewhere up there. That's where all the stops are for the guys getting short now, and I think I think there's one more head fake to the upside that's coming.
All right, what's your percent correct?
You're going to think I'm nuts, but I'm going totally with my gut on this one. It's at like 99. I'm like,
wow.
We're going to be higher. We're going to be higher on Friday, and regardless of the volatility that happens on non-farm in the morning, I think that I don't know if we'll close up at the high end, but I think we're going to be higher by Friday. It could be the head fake reversal, mother of all reversals on Friday afternoon. But I think that if you're looking to get some position on early in the week, like right now, and be higher sometime on Friday, early in the day, I think there's a real strong, like better than 95, 99% probability that's going to happen. And then afternoon, then that could be, who knows. But I really think we're going to be higher by Friday. I really do.
Gotcha. Sam, let's go to you. Same question. Up or down, and percent that you have correctly predicted that move.
Well, I think Jason is convincing me to change my mind there after that. But
don't do that. Don't do that. Stay with your point of view. Don't let anybody influence it.
Yeah, I had originally agreed with the consensus. I expected the movement to be downward this week. Essentially, agreeing with a lot of what was said earlier by James about there not being a lot of activity. And the reason why I predicted a downward movement this week is because I've been, following the VIX rather closely. And what we saw was about a week and a half ago, the VIX really plunged, and it hit oversold levels on the RSI. And we immediately forecasted it was going to, bump up and go the other way, and that's what happened last week. Based on the research that I've done, usually when volatility declines really quickly, it's usually associated with a correction a little bit later. And we know that the volatility index is inversely related with the S&P 500 about 80% of the time. So given that I expect the volatility index to creep up this week back toward the historical level, I expect that the S&P 500 to go in the opposite direction. So I would say I'm about 60% sure that we're going to be looking at a downward movement in the S&P by Friday.
Okay, gotcha. I'm gonna suggest, or not suggest. I'm one thing that a lot of people have sometimes confused is like I said earlier. I think you can only predict the short term when it comes to markets. That doesn't mean that you can predict the market every week. I look for very specific setups and patterns before I dip a toe in and actually make a trade. But as far as being forced to make a prediction, I think it's kind of interesting. And I'm going to go ahead and share charts now. So if you guys want to get some charts ready, that'd be awesome. But you can see the S&P 500 has worked its way higher in a fairly persistent manner, meaning that it's going up pretty much day after day after day, for the most part, for, I don't know, I guess about a month in here. So that's pretty impressive. But I think you have to look at the forest for the trees. And again, I'm not a huge fan of indicators, but I've got what I call my bow tie moving averages in here, which is a 10 simple, and hopefully it's the same on this computer, but it's supposed to be a 10 simple, a 20 exponential, and a 30 exponential, and then on a weekly chart, obviously that's on a 5-day period. We had this major sell signal last summer, and so far it really hasn't. I guess you could say that, well, the market's dropped somewhat, but now we're back towards the old highs. And the thing to remember, though, is that we haven't made a whole lot of forward progress in over a year in the S&P 500. I think last time I checked, I don't think it changed, but I think 2015 we were down like 0.75% for the entire year. So never forget about the net change. And then if you look at when we had these signals before, these major sell signals and these major buys, you can see that the market has had major bull markets and major bear markets afterwards. And when I call it major sell or major buy, it's coming off of all-time highs or many, many year lows, like the case of 2009. That was coming off of a 13-year low for the market. And maybe it's due to be wrong, but I'm going to stick with the bear side as long as this signal remains intact. And one thing you could do, and I have plenty of free reports on my website, and this is one of them there, so there's nothing secret about what I do. If you want to download the free report on bow ties, it's on my website. And the thing about what I found interesting is not that you could necessarily hold on for the entire ride, but it kind of gives you an idea that a top is in place. For instance, you have the bow tie here, and until this market makes new highs, I would consider us in potential sell mode for the S&P 500. Doesn't mean that I won't buy any stocks. We're actually long more than we're short. Now we're long commodity-related stocks, so you could argue that, well, they could trade contra to the overall market. But as long as we're under this sell signal, and again, for that to be negated, we'd have to make new highs, I would remain cautious about this overall market. And again, I think if you didn't know anything about a market, just look at what the market is today, and then go back in time and draw a straight line. You can see you can go all the way back to 2014. Let me just show you something really quick, and then I'll let everybody else jump in with charts. If you go back to, if you take a look at the Rusty, you can go back all the way to 2013, and you can see that we haven't made a whole lot of progress since then. And by Rusty, I mean Russell 2000. You also have the major sell signal here. So far, we had a pretty serious thrust down and just a little bit of a pullback. So Russell 2000, I think, is a little bit more indicative of what's happening internally with this market. Okay, Dean, let's hop over to you. I see you got your charts all ready to go. So let's tell us what you think based on the charts. And I guess the official question is, what developing events will you be watching? Let me get the report in front of me here.
Yeah.
What developing events, technical or fundamental, will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets? To you.
Okay. So I think you can see my screen. You said now, right? I've got the E-mini, the S&P 500 futures contract, up in front on my screen here on a 60-minute time frame, and I like the 60-minute for predicting, what's going to happen the next week. I'm a bear on the longer-term market, and I think my analysis is really similar to yours that you shared, Dave.
Thank you.
That's funny that leg up that you showed, the current one on the S&P 500 that started, kind of mid-February through now, I think it is. Its timing and price are almost identical to the move we got off the bottom last summer. In terms of, it's like 25 trading days, and the number of points, it's within a point or two. And so if you believe in symmetry in the markets and that patterns repeat, that may be indicative. But anyway, on the 60-minute ES chart here, I've been watching this for several weeks, and we had a pretty classic five-wave Elliott wave pattern play out on the 60-minute chart, and we fulfilled the fifth wave into the target zone, even went a little bit above, and now we're seeing a pretty clear turn down, and you can see we've been having bearish divergent build in this trend. Even as it went higher, the amplitude was coming out of it, and the down moves are starting to add momentum. And this latest move, an uptrend is defined according to Dow theory by higher highs, higher lows, higher highs, higher lows. And this latest move took out some key support levels, and then when it pulled back up, it did not go put in a new low. And so the real thing I'm watching for right here is if the next move down puts in a new low, then we're in a new down leg, and that's a corrective wave to this big uptrend.
It sort of looks like a fractal version of the daily chart, which is, I think that's what you're saying. That's kind of interesting. I like that.
Yeah,
That's
and
cool.
then if we go, but so if we go put in a new low, we take out this level here, which is at about 2013. Then this pattern, it's on, man. We're heading down even lower. If we do go put in a new high, take out this last high about 2046, then I think Jason is right. The uptrend has continued, and this was just a momentary, stall in that. But I think the high probability, given the bearish divergence, the uptrend that we have, the bigger picture, I think the higher probability is that pretty quickly we're going to turn down here, and put in some new lows. Even lows from the closed from today. Lows from today's open by the end of the week. I think we'll be seeing those lows, but that has to be proven. It has to be proven.
So
And it's not
you
yet.
said if we take out those lows, it's going to be on. Is it going to be on like Donkey Kong?
We're going to start a down leg. We're going to start a down leg, right? I don't
Gotcha.
think, the evidence for, a massive decline like we saw last summer, another repeat of what we saw at the beginning of this year. Don't know. The long-term picture for the S&P 500, it's going to, just using, Fibonacci levels and retracements from, that 5-year bull market we had, it's gone down, 30, 40, 45% from the highs. But that's going to take time to play out through this year, maybe into next year, for sure.
Yeah, and the other thing too, it's what a lot of people fail to remember is markets go up and markets go down, and obviously anybody who started investing in 2007 learned a lesson on that because they lost half their savings the next year that they invested at least. And it's funny, since 2009, since the market is just going pretty much up, it's like a new batch is born. And somebody recently contacted me, one of my wife's friends, and she's freaking out a little bit because she just started invested last year. She's already underwater. And her guy's saying, oh, we're in for the long run. The market always goes up longer term. And it just does not. And I think everybody's beginning to forget that. Anyway, James, let's go over to you. James, what developing events are you keeping an eye on for this week?
So I'm going to keep my eyes pretty closely on volatility and what expected moves are looking like this week. Like I said, we're lacking the micro catalysts this week, and we do have the jobs number on Friday, which should bring some volatility into the market. I mean, it's still an important macro data indicator here, but if we take a look at what we're looking at through Friday, I mean, I can't explain why market makers are only pricing 21 points worth of action in through this next 5 days with that jobs number on Friday as well. I mean, it includes that jobs number. It includes all of the Fed governors who are speaking this week. I would expect there to be a little bit more movement. At the same time, we also use an indicator that looks at block order flow in the S&P futures, and it would seem to me that last week we saw a lot of big block buying between 2020 and 2025, and this morning, right after the open, we saw a huge block of S&P future contracts sold at around the 2028 area. So not only is the equity options and options on futures market defining what should be a pretty tight range for this week, the order flow in the S&P futures themselves seem to be confirming that as well. So I think we're in for a real choppy one. I think this might be a good week to buy lows and sell highs at key support and resistance levels. But with all of that being said, it does seem that there is kind of a standing sell order in the market here near this 2040 area. So I think if we test up to that, it could be a good short. Testing down to 2020 could be a good long. I expect us to kind of yo-yo back and forth in between there. In the meantime, some developing event that can always happen at any given time is a huge order that I might see in some ETF or interesting symbol that would change my opinion on what I'm looking at here. One thing that we were kind of hoping to see last week that we did not, and one of the benefits of a holiday week is that unusual option activity is a little bit easier to spot because there's less order flow in general. I was kind of hoping to see some activity in the XHB or some of the home builders, as those are the only names that have really yet to report earnings, and we didn't see it. It didn't come through. So I'll be looking to play ranges this week, and anything that could change, I think, is going to be driven by order flow, but I'm not really waiting on bated breath here because, I mean, it's been dead quiet. Normally we track
James,
Sorry, go
little
ahead.
quick question. When it's quiet like this, Do you think that somebody might be waiting in the wings and use this to take advantage of the situation, tip the market one way or the other?
Yeah, generally when there's a couple of different ways that you can look at it. Sometimes we say, all right, this is just a time when hedge funds, money managers at big mutual funds and institutions are just sitting on their hands because there is no catalyst that's going to drive the breakout. Kind of can see this happen as well as we're in between key levels of support and resistance, right? When we're kind of in no man's land, nowhere near a breakout region or breakout point, why would they come in at that time unless they had a really good read or a really high level of conviction that we're going to see some kind of significant move? Well, then they're just going to be getting long premium and paying time decay. And if we're inside of an area that is relatively choppy, volatility comes down, options premiums erode away. So I think that once we get through this week, we start an earnings cycle next week. I believe Alcoa reports on Monday morning, a week from today, maybe in the afternoon on Monday. Then we might see, at least in individual equities, some more order flow, and that tends to kind of lead to more order flow across broader plays and ETFs. They come in and start to put their bets on for, hey, this is what we think this sector is going to be like this quarter on earnings, and we'll start to see some large plays coming in kind of the sector ETFs and in some of the broader market stuff. But in between now and then, like today, I have tracked not one significant order that meets our filtering criteria, when on a normal day by this time, 12:30 Chicago time, I'd have a handful of them that I could look at. And this is kind of the same thing as last week. I mean, it's just dead quiet.
Gotcha.
Yeah.
Gotcha. All right, Jay, so let's go to you. Same question. What developing events are you keeping an eye out for?
Okay. I don't know how to say this other than to make it sound like I've done my homework. Okay, because let me tell you what I see happening here for the past 90 days, and I think that's why we've got more upside potential, despite all these really good arguments from the bears and really good analysis on the state of affairs. I think people are missing exactly how the change in the structure will develop. And I just want to remind you, I want you to stop and think about this. The stock market really can't go any higher unless money is pumped into it. People have to buy something for the most part, right? And the amount of stock that was bought back by all these major corporations that are considered to be high-quality companies was absolutely staggering. The free money that was allowed by the Fed's point of view to just be filtered right through into the hands of people who can say, wow, we can borrow money for next to nothing. Let's buy back our stock. And they did that. And now all that money that was pumped into the marketplace, that stock is now available for sale again. And that means the public is going to usually be on the buy cycle. And here's where I think the money is going to come from, is that those stocks, the huge amount of stock that was taken out of the marketplace with the cheap money over the past several years is starting to come back in at higher prices right now. And the public, who was always getting their rear end kicked in this business, those people, the largest investment group that comes from that side of the equation are pension fund managers. And every week, every 2 weeks, every month, there are huge amounts of money being set aside, people maxing out 401ks and IRAs and all that kind of stuff. And that money is being pumped into retirement programs. And I just think that is there's one more push higher coming from all that cash that is still participating on the buy side, because you don't find guys that use short positions in IRAs and 401ks and other retirement plans that got a 15-year window or longer time horizon. What I really think is happening is that as we get into an election year, and there's plenty of time for all the debate to happen about what this means long term. The bottom line is the Fed is just not taking away the punch bowl. There's lots of money going to be coming in for lots of reasons. It's all going to be free cash. That money is going to get pumped right back into the stock market one way or the other. And the bears are absolutely right, but I think they're early. I think they're early because there's one more round of big buying happening, and I think this quarter said it all. When the fact that everybody thought the Fed was going to raise rates, nothing happened. They keep the rhetoric is more dovish than ever, but you can't find a dollar bear anywhere, and you've got mediocre data. And yet the stock market keeps right on climbing month after month after month, little retracements here and there. But you look at the monthly charts, these massive bid wicks underneath all these sell-offs. And I just think that that isn't over yet. I think there's a little bit more to go, and I think this quarter basically set the stage for another round of bids coming in April, May, and June. Now that could change, but I think if the data is reasonable this Friday, you're going to see a lot of people are going to start coming in with, the regular weekly and monthly retirement money. Those people put it all in bonds because they didn't know what was going to happen. They thought the Fed was going to keep raising rates, and they wanted to be safe, and they thought the stocks were going to go south. None of that happened. So there's a lot of money coming out of bond funds that are going to go right into stock funds, and I think that that's all retirement money, and I think there's a lot of that out there, and I think that the people who are in a position to move those funds around, I think they look at this and they say, look, the cost of money is zero. Until that changes, there's no reason to be worried. There's lots of money to be made in the stock market. And I think that they're all good with that. So that's my argument.
All right, Sam, let's go to you.
Yeah, I agree with the whole Federal Reserve and the argument about lower interest rates. I've been monitoring the U.S. dollar quite a bit over the past week and a half, and we saw essentially 6 straight days of gains for the U.S. dollar, mostly on the back of rhetoric by a whole bunch of different Fed governors about higher interest rates as early as next month. If you heard Bullard last week, I think Lockhart as well as Lacker as well, talking about higher interest rates and this and that. If you look at the the federal funds futures rates, you still see that expectations for a rate rise is very, very low. But nevertheless, I think that the data on Friday could kind of reignite interest or reignite speculation about the path of interest rates and whether or not we can see something happen by June. So I'm really looking at the performance of the dollar over the next couple of days. That really interests me. Last week we saw a higher dollar and falling oil prices as being the main headwinds for U.S. stocks, at least from a fundamental point of view. And the economist in me definitely wants to look at the performance of the dollar and what that says about interest rate expectations. So Yellen tomorrow will definitely provide clues, but I think that she'll be a lot more balanced in what she says than what, for example, Lockhart said last week, which essentially was that we can see a rate rise as early as April. So definitely going to be monitoring the Fed chatter this week and how that influences overall investor sentiment.
I think the dollar is topped, but like the S&P 500 and a lot of these other markets, it's just taking its own sweet time. It's just got to cook it in here. Well, again, I'm right, but early too. Damn it. All right, good, just great stuff from everyone. Again, no controversy this week. Let's go back to Dean. What is your best advice for trade management? That's the question of the week. What is your best advice for trade management?
Okay. Oh, that's a great question. So, I'm always more comfortable when I got a chart in front of me.
I hear you.
So here we go.
So am I.
Yeah. In fact, let me pull up a trade we're in right now. It's just because I can make a case. So, my best advice for trade management is have a plan, a set of trading rules before you ever put a trade on.
Amen.
And have a well-defined.
Amen, brother.
Have a well-defined entry point, a stop level price, a target price you think it's going to. Make sure the reward to risk ratio is good, that you have a chance to make more than you could lose, and then have a strategy, a predetermined strategy about how you scale out, take profit along the way, and how you exit the trade. If you don't have a plan going in, there's a high chance you're just going to be making decisions based on emotion, and that works against you rather than a proven set of trading rules that produce profit consistently over time. And so here's an example of a trade we're in. We saw gold breaking out. I said if gold went above 1113, then a corrective wave to the massive bear trend it had been in for years had reversed, had changed. So when gold broke 1113, we started getting into gold mining stocks, and so we got in here at $1.25 on this one. The initial stop down here under the previous low, and what we do is we take profit along the way. When it reverses, we take a third off. When in profit, reverses in profit, we take a third off. It reversed again, we took a third off. Now we've got a third still on. It's up above our initial target zone, and we simply trail our stop up to well-defined support levels. An uptrend is higher highs, higher lows, higher highs, higher lows. So when it puts in a higher low, makes a new high, we trail our stop up, and that's my strategy. That way, you stay with the trend until it has proven, the reality. The only realities in the market are price and volume. Everything else is opinion, right? But you cannot dispute.
Good stuff.
Yeah,
good stuff. I mean, you're stealing a lot of my answer here, but you reminded me to make sure I reiterate all those points. But yeah, fantastic stuff. Jason, well, let's go to James first. James, you're up next. Let me grab the report here. Actually, dropped the report. What was the question on? I had it in my head. Let me just make sure I get the wording right. What is your best advice for trade management?
So this is going to sound kind of surprising probably to a lot of people, but when it comes to equity options and particularly unusual options activity, I never really know for sure with 100% certainty what a trader's motivation is when they come in and put on a big block of options. Like I said, there's a lot of different things I can look at to kind of figure out what the most likely scenario is, but because of that uncertainty, I'm always worried about risk in equity options. So one of the things that I do to manage that risk is I determine what my maximum level of risk should be in any given position, any one position. And typically speaking, because I trade a lot of different positions, I never want to have more than 5 to 7% of my book in one given position. But the way that I'm able to manage my risk with certainty is by not using stop losses at all. I never, ever use stop losses in equity options. And the main reason that I do that is because I'm worried about gap risk and what that might mean to my actual maximum risk level when I'm in a position. So for example, if I want to buy 100 equity options at $1 with a stop at 50 cents, my risk is technically $5,000, right? If I get stopped out at 50 cents, I lose $5,000. But let's say that this stock that I have these options in, some black swan news event happens after the close, and I'm long calls in that stock, and I come in the next morning, stock's down 30%. Is my 50-cent stop going to hold up, or am I going to lose much more than $5,000 in my position, right? Those options are going to be worthless. No one in their right mind is going to give me 50 cents for them. So I've actually lost a lot more in that situation than I thought possible and have lost more than what my maximum risk rules allowed me to. So what I would rather do than buying 100 contracts at $1 with a stop at 50 cents would be buying half as many at $1 and just saying to myself, if these go to zero, then I lose $5,000, and that's it. Now, with that being said, as soon as I get into that trade, I need to have profit targets out, and I have to make sure that, hey, if I'm buying these for $1 and willing to risk one full dollar, I can't start selling them at $1.05. Right? I'm getting a terrible reward to risk setup there. But that's one thing that I think is something that we need to consider more and more, that type of gap risk management, because, we have these events all the time, and they happen in individual equities, and I don't know if anyone would agree or disagree, but I would say that they're happening much more often than they used to. Mini flash crashes where we have a huge amount of stocks intraday selling off massively and gapping lower only to come right back. Kind of the market dynamics have changed, and the systemic risk of something like that happening, I think, is higher. So that's my number one piece of advice, is always understand that even if with stop losses in place, the maximum amount of risk in a trade you can't ever rely on a stop loss to get you out at the price that where you're willing to take losses. It can be much worse than that, and you have to keep that in mind.
Yeah, I just want to point out, you're not saying to everyone else, not saying you don't have a plan in place. You have a plan in place. It just doesn't incorporate a stop, and then in that case, you're reducing your share size down to incorporate the fact that you don't have a stop. So two different things other than to say that you don't use stops or anything.
Right.
It's like saying you don't use risk management. You have a very solid risk management plan in place.
Oh, yeah, absolutely. And I probably should have been a little bit clearer on that.
No, you were. I think you were perfectly clear. I just wanted to kind of reiterate the point.
That idea works really well in equity options. It's I don't trade futures. I don't really trade stock that often unless it's against equity options, and I don't trade currency pairs. If I were just to go buy futures or sell futures outright, trust me, I 100% absolutely would have a stop in place.
Yeah, absolutely.
I have to for that type of idea, but because my main vehicle is equity options, I'm able to make those considerations and kind of change my maximum exposure, because the best thing about options, they can't be worth less than what I paid for them.
Right. I mean, unless you're trading a really, really deep in the money option,
right.
You could always say, okay, what's the worst could happen? It can go to zero, and you have to be willing to live with that fact, because sooner or later it will, as you know. So yeah, good stuff. All right, Jason, let's go to you. You need me to reread the question?
No, I think I got it. What you're saying is that what would be your best strategy plan for I guess both risk control and maximizing profit? I think this whole conversation so far has been all psychology. If you really boil it down, I mean,
I agree.
Yeah, different points of view, and I'm really glad that James says, look, it's not about not using a stop. It's if I was trading other markets, I'd have a stop in. What he's saying is the nature of the vehicle he's using for profit opportunity gives him an advantage if he chooses to do it this way. So I think that's a tremendously strong psychological component. What I teach people in my psychology of trading course is I tell them that money doesn't come into your account based on what the market does. Money comes into your account based on your discipline to perform according to your plan. Because if you don't perform according to your plan consistently, you're not going to be in the market when it finally does what it's going to do, and you're going to be holding losses that are the market will take more away from you. So it's your lack of discipline that doesn't pay you. It's not the market doesn't move one way or the other, and that either puts money into your account or takes money away from you. It's more along the lines that if you're using a disciplined methodology that has really strong, credible probabilities to it, if you fudge on that system, that's where your losses come from. You don't want to do that. You want to maintain absolute flawless discipline. And for me personally, since I trade in the major pairs, my discipline is really, really simple. If I get a lead on the market, I hold that position, I look to add to it, and my only goal is to get to the point where I can put a break-even stop on it, and then a lock profit stop, and then wait for the next signal to add to it. And if I can still be in that trade 6 months or a year later, that's fabulous. Based on what typically happens, that doesn't happen. But the point is that I do A, and then the market does what it does. I do B, and then I do C. And if I can get all the way to C, it's possible I'll stay in that trade indefinitely. And that's just discipline. I'm just not taking off the winner. I let it work. And if I'm wrong, I'm out.
Well, we had a conversation on one of the shows, and I wasn't sure if it was you or not, but somebody said that, and I fully agree with it, they put out the same exact data, their same exact recommendations or whatever, and some of their clients just print money, and other clients lose money, and it's the same exact market, the same exact setup. So what's the difference? Well, some of them followed the plan, and some of them didn't.
Right.
Yeah.
Exactly.
Sam, let's go to you, because Jason and I can go back and forth about 3 hours or more.
We get yelled at for doing that. So.
Yeah, we'll get in trouble. Sam, let's go to you. What's your best advice for trade management?
Yeah, honestly, everyone here really covered it. It's all about trading psychology. I don't want to keep hammering that point home, but it's the truth. I mean, so much of the work that I've been doing when talking about volatility has been really about educating, about traders about how to, manage their trading psychology with respect to greed and fear. It always comes back to greed and fear, greed and fear, greed and fear, and especially dealing with a lot of new traders. We see that there's a lot of sense of false expectations in the market. So, I mean, all the work that we're doing has been really around educating as much as possible about what the realities are in the market and how to really set up your expectations accordingly. So, trading psychology, I think, is a vastly underrated subject. Not on this show, but in most other areas. Because I think that most of us here, or most of us that are actually watching, are disciplined enough to actually go out and learn how to trade, learn different trading methodologies, learn different techniques, learn about how the different indicators work. But it's all about, wrapping that in with a broader context of a well-honed trading methodology based on sound trading psychology. So everything here that was said about risks and managing risks is definitely on point.
Yeah, absolutely. It's funny. Before I read today's report, in my stock trading, I guess I've been doing it for so long. It's like years ago, I did a lot of commodity trading, and then I've kind of come back to the floor, just kind of like S&G type of trades, kind of more of a day trade type of thing, or intra-day trade, whatever, but over just a short period of time. And with the equities, I really don't watch every tick. I really don't care about every tick so much. I just let things unfold. But I find myself with Forex watching a little bit too closely, I guess, because it's always something exciting. It's always moving, something happening. And this morning, it was really pissing me off. So I said, you know what? I'm just going to put in a hard stop and turn the monitor off. And I later found out I got stopped out. So I lost on a trade. So what? And I was able to move on in my life. But if I'd have sat there and watched every little tick, I'd have been inclined to maybe move that stop a little higher, give it a little more room, or I'd cuss and fuss. It would have stressed me out, and I wouldn't be able to focus on other business at hand. So my quick advice to the answer would be, to the question would be, turn your monitor off. Initially, I wrote down Amen, Brother Dean, but I could easily now say Amen, Brother Jason, James, and Sam as far as the answers when it comes to psychology. One thing I wrote in my book, The Layman's Guide to Trading Stocks, is that money management will cure a multitude of sins. So I like the way Jason kind of always brings it back to psychology, but if you're trading at a small size, you're not going to be so stressed out to where you're going to watch every tick, and you still will be able to have your lifestyle. That's what I tell most people. If you can't follow your plan, then trade down to a small size when you can. And if you can't, if you're risking just a minuscule amount in every trade, you still can't follow the plan, then maybe you need to think about another career. The bottom line, I know it's cliche and everybody says it, and I think I even heard it a couple times today from you guys, plan your trade and trade your plan. Plan your trade while things are static, while information is not changing. Once the information begins to change, it's been proven that stress begins to go up dramatically. So you have to figure out a way to follow that plan, which, as I said a second ago, sometimes means just turning off your monitor if you have to, and not watching every tick. The market's going to do what the market's going to do, whether you watch every tick or not. The only other thing I want to point out is, and I think Dean kind of touched upon this quite a bit, and I fully agree with a lot of things he said as far as the position management is concerned. Like I said earlier, you can only predict short term when it comes to markets, and I think you could. So that means you could only trade over the short term. But if you have a really good setup that you have a fairly highly accurate chance of making money on, and you could keep that stop relatively small based on the shorter term volatility. And when you're able to get that initial profit target out of the position and bump the stop up to break even, like I know my brother Jason over there likes to do, then you're in a great position, and then you could slowly let that stop gradually widen out, often not by doing anything, and that's kind of the secret sauce for me to ride out a longer-term winner out of what started as a short-term position. And people often ask me, is my money and position management statistical or psychological? And my answer to that is yes, because you're able to satisfy that short-term craving for some excitement, for lack of a better word, or that short-term fulfillment and reward. We all live in this microwave society. We want instant gratification. But then I think the bigger ego thing is being able to capture that longer-term trade. And that's where the real money is, too. If you're only making a little bit of money on each trade, then sooner or later a big trade's going to knock you out. And if you can survive that, it's going to take you a long time to come back. But if you can position yourself to where you can occasionally ride out a longer-term trend and make a lot of money on a few trades here and there, and all it takes is a few trades a year where you really knock it out of the park, then you'll do just fine longer term. So, again, plan your trade and trade your plan. I know it's cliche, but if you can't do that, I wrote a column just recently, and I swear I'm going to wrap it up here, but I wrote a column just recently and said on your next trade, and just that one next trade, I guess it's kind of like an alcoholic, okay, just for today I'm not going to have, don't worry about the next 10 years or 20 years, do it just for today. So just in that next trade and only in that next trade, and I've gotten quite a few emails from people who have signed on with this and made a pledge to me that they're going to do this. They're going to follow the plan, and good, bad, or indifferent. And you have to be very process-oriented. So, again, I know it's cliche. Plan your trade, trade your plan. If you can't do that, go down to a share size until you can, and if you can't do that on the next trade at a very small share size, then you might need to rethink this whole business. All right, not to end on a negative note. I think that's a positive thing, though. I think anyone could do this if they truly want to do it. Let's go to you, Dean. Any closing thoughts on anything that we said, or anything else you want to tell us about FollowMeTrades.com or your own trading on the markets? The floor is yours.
Okay. Yeah. So this was a good discussion and some valuable stuff shared. And just to echo your comment about the need for some big winners, right? You got to trade your plan. You got to have a plan. And if you look at the risk of ruin tables, because money management, risk management is foundational to everything I do. But you can actually have a lousy win rate. You can be at 30-40% win rate, but if your payout ratio is high, meaning you have a handful of big winners and your losers are controlled, you can still be very profitable, right? If you push your win rate up, you can be wildly profitable. So
yeah, we're going long today, but that's the misnomer in this business. People think a high win rate is what you need to aim for, but a lot of those strategies, they make a little, then they occasionally blow up, and that's what the so-called anthill strategy will kill you. I'd rather make a lot of money and not be accurate than be accurate and then blow up every now and then. Anyway, keep going, Dean.
Amen. So here's the website. It's FollowMeTrades.com, and I offer stock picks. I got education, and there's a free newsletter every week. I publish my forecast on the markets. I look at S&P 500, the Dow, gold, and oil, and just give my forecast for what's going on there. And then, of course, people can subscribe to stock picks. So FollowMeTrades.com. Love to have people check it out. And it's great to be here. Great discussion. Thanks.
Yeah, amen. I hate to have a love fest, but once again, great show. James, let's go to you over at AlphaShark.com. Any closing thoughts?
Yeah, so I can't agree more with that idea of win rate, and I think that win rate is, as a statistic that representative of trading success, is completely and utterly useless. If you guys want a strategy that wins 95% of the time, I can give you one right now, and it's going to take no time whatsoever. Go find whatever put on a monthly, weekly, daily basis, what have you, in the SPY with a 5 delta and just sell that. 95% of the time it's going to go to zero and you're going to make money, but the one time that you don't, you're going to blow out your trading account. And this is kind of the name of the game with options. I think that line of thinking applies to every product that you might trade, but is specifically apt when we're talking about options, because this is how it kind of tends to go, right? Especially when we're looking at taking options trades ahead of potentially large moves. If I lose 100% of my invested capital in 4 trades in a row, and then the 5th trade that I take, I septuple my money because of a large move in the equity in the underlying, have I made money overall? And am I fine with that type of win rate? The answer is absolutely. So if you guys want to hear a little bit more about what it is that we offer and how it is we go about approaching equity options markets, you can go to alphashark.com here and sign up for our Trade Like a Pro workshop series. Just put in your name and email, and you're invited to our weekly webinar series, which we host on Saturday, Sunday, Monday, Tuesday, Wednesday, and Thursday. Hour-long webinars about a variety of different topics, not just equity options. We talk futures, stocks, and ETFs as well. And if you have any questions about anything specific we just talked about, please feel free to shoot me an email, james@alphashark.com. I'm pretty good about responding within 24 hours, but sometimes I'm a little swamped, so just feel free to drop me a line.
Okay. I have a few things I want to say about what you said, but I'm going to wait till it's my turn. Jason, let's go to you. Any closing thoughts?
Sorry about that. Forgot to turn my mic on. Yeah, actually, I had just one or two. First of all, I love doing this show, and I hope you guys continue to invite me back regularly, because every time I'm here and there's some new guys, like Dean, I think is the first time I've partnered with him on one of these shows, I always learn something. And I can't stress that enough for the listener, the guy that's out there trying to figure out, how to do this, what his strengths and weaknesses are, and what to expect. And you never learn how to do this. You just learn to get a lifetime learner's permit. That's really what you do. And I just can't emphasize that enough. And so I wanted to invite people to come to the education I offer. And I'm going to try to do a screen share for the first time with you guys here. So would you please tell me if it's showing up here? Are we there or no?
And there's a lady in a bikini.
Lady in a bikini. Okay, yeah, okay.
Wrong monitor.
Right. Is this showing here? It should say my name, the Lion Online, right here. You guys got that or no? Nope.
Yeah, we got it.
Okay,
you did.
good. Cool. Just give me 30 seconds here. Just want to tell you guys because I haven't really shared my screen. A lot of people said, "What was his website again?" and they forget. So it's theliononline.com. And all you got to do is opt in. This screen is the opt-in for Jumpstart Your Trading. It's a 5-video series. It's great for newer guys in the business. I've got other opt-ins you can get to. All you got to do is say, well, hey, look, I opted in for this free stuff, and this is pretty basic, too basic for me. Great. Just go here to where it says contact and ask me for a little bit of time. All you got to do is go right as a new feature. I'm right here, request a call. All you got to do is say, I want to talk to you, and I'll give you all the free stuff I've got, which is lots of different little things that are at different education and sophistication levels. And I want to remind you guys to come to my blog where I've got every week, I put my weekly performance out week after week after week, starting from the beginning of the year. For the first 10 weeks of this year, I'm up on this model accounts. These are real money, real time model accounts. I'm up significant gains for the year. And I want to show you that this is absolutely 100% learnable, and you don't need a lot of cash to do it. And if you're willing to make the commitment like others have, I've got some tools to help you with, and that's all on the site too. So I just wanted to say thank you for having me again, and I love doing this. I hope you guys keep inviting me back, and for you guys that are still learning a little bit about what I do, just go to my website, and I can show you performance in real time, some free stuff. I'll even be available to you by phone if you want, and hopefully you'll like some of the products I've got, which are all based on the psychology of trading. And let me find a way to, let me turn off my screen share here. How do I do that? Is it off yet? Cancel. I think that's it.
You like hit share again or something.
I
Hey
don't
Sam,
know.
we hadn't forgotten about you. Any closing thoughts?
Great. No, I just like to thank you again for having me on today. It was an amazing talk. As I mentioned earlier, I'm part of TradingGods.net. We're a complete trading system dedicated to helping investors learn about volatility. I mentioned earlier that the S&P 500 and the VIX, they trade inversely about 80% of the time. And part of the message that we're trying to give on TradingGods.net is that there's a lot of opportunities for trading volatility, regardless of the market condition, whether it's going up or down. So we currently offer the VIX Trader. If you go to TradingGods.net/VIX Trader, you can learn more about that. It's a complete understanding of the VIX ETF market, as well as how to leverage volatility, regardless of the current market conditions. So we cover daily articles looking at the daily wrap-up in the VIX. We also have a weekly webinar that explains the week that was in the volatility market and what's coming up in the next week. So yeah, great. Thanks a lot for having me, and I really appreciate the time, and hopefully I'll be on again sometime soon.
Glad to have you, Sam. My name is Dave Landry, again, DaveLandry.com. It's a pretty easy website to find. Each week I do a webinar. If you go to the home page and scroll down, you'll see the next webinar will be on Thursday. And it's kind of ironic. In last week's webinar, I was telling everybody if you see a so-called income-producing strategy, such as selling options, don't walk away from it. Make sure you run away from it. It's something that's interesting what James was saying about those type of strategies. I'll give you a 95% correct strategy, selling those low delta options. And it's been said that that type of trading is a great way to have a very brilliant but brief career on Wall Street. So, and as I said in last week's webinar, which you could get off YouTube, is that'll work until it don't. Speaking of the webinars, again, I do a webinar every Thursday. I lecture a little bit about the market. In recent times, I find myself spending more and more time on psychology, as Jason points out. It's a very, very crucial part of trading, and we talked a little bit about psychology last week. If you do want to participate in the webinar, again, just sign up on my website. Bring your questions and bring your favorite stock picks, and we'll be happy to talk about them. Also, if you're really serious about learning how to trade, if you go to my website, I have 3 sort of ways to get started. Help me get started, help me get moving, and get on the fast track. If you're really, really serious about getting started trading, I'll give you an hour of my time. So feel free to check that out, and I'll be happy to talk with you. In the past, when I used to do mentoring, it's something I haven't done in a long time. I might do it again. But in the past, when I used to do it, I'd spend a free hour with people, and usually within that 1 hour, I could identify a lot of problems and help people out tremendously, whether they bought anything or not. It's kind of rewarding for me. It's amazing. If you want to know what somebody's doing wrong, and I think Jason will agree with me on this one, just ask them, and more often than not, they'll tell you. And if not, you could pretty much figure it out pretty quickly what they're doing wrong. And it gives us the very simple things to help them follow that plan, and of course, plan and trade to begin with. Anyway, we've gone kind of long today, so I don't want to pontificate much longer. Let me turn the show back over to its creator, David Kosmider. David, thanks again to you. Thanks again to Timing Research, and thanks again to all you guys for being here. This was,
thanks for having me.
You know, I know I say this quite often, but this was one of the better shows, or one of the best shows that I really enjoyed. And I got a lot of notes here. I'm going to go type up as soon as I get done with the show. So thank you guys again for the show. To you, David.
Yeah, thanks, guys. Great show. Just want to remind everyone watching, you can go to TimingResearch.com and you can download past reports or view past episodes of the show there. Also, the question for this week on the reports and on the survey was actually submitted in a previous week on one of the surveys by someone who filled out the survey. So if anyone watching has an idea for something they'd like to see on a future survey, just submit that as a comment, or go to the contact page and send me a message there, and we'll get that on one of the future surveys. Next week we have Lance Ippolito, Sam will be back, Sang Lucci, and Matt Buckley will be hosting. So, and I just want to thank my guests again: Jason Jankowski of TheLionOnline.com, James Romelli of AlphaShark.com, Dean Jenkins of FollowMeTrades.com, Sam Borgi of TradingGods.net, and of course Dave Landry. Thank you for hosting again.
Thank you.
Thanks again. Appreciate it.
Thanks, everyone.